Welcome all to the BiggerPockets YouTube channel. I am your host, David Green, who's also the host of the BiggerPockets Real Estate Podcast, here today with my best friend that's not named Brandon Turner, also the Chief Operating Officer of the David Green team, top 2% realtor in the Sacramento market, and all-around stud, Kyle Renke, to talk about what is happening in today's market. Kyle, good morning to you.
Good morning, David. Thanks for having me here.
All right, so you are in the thick of things as a top realtor and somebody who's a high producer on the David Green team, as well as training all the agents that are on our team and overseeing the entire operation. What are you seeing right now in the market as far as clients' concerns?
Well, first of all, there's obviously been a shift in the market, and everybody can see that and feel it. I would say there's two primary concerns that we're seeing within the market and within the buyers and the clients that we work with. Number one, it's, hey, the interest rates, they seem like they're continuing to go up. I don't know if I'll be able to make my monthly payment or if I'll be able to find a good deal out there. And then the second thing is, what's going to happen with the market? There's a lot of talk about the market potentially crashing and a recession looming. So those are the two biggest things that we're seeing right now.
Yeah, that is pretty frequent talk. And I think that that's indicative of people's concerns everywhere, not just in our local market. I think everyone's kind of looking at what is going to happen with real estate. Now, one thing I've noticed about how people make decisions is that everybody wants a good deal. And in order to figure out what a good deal is they typically form a baseline of what they think a property is worth. It could be the appraised value. It could be the list price. It could be the cash flow. And then they say, I want to get this property for either less than what my baseline is or a higher ROI than what the baseline is or something that beats the average. But as we're seeing interest rates continue to tick up, it's sort of like the baseline understanding of what a property is worth keeps changing. And so no one really knows if they're getting a good deal or if they're not getting a good deal. So with the clients that you're representing, is there any patterns that you're noticing in the people that are getting the better deals?
Yeah, I would say number one, the people who are getting the better deals are the ones that are being willing to be more patient. In the past 16 to 22 months, people had to move really quickly and jump on properties just to get their offer accepted. Now we're seeing properties with longer days on market, and the clients that are willing to sort of take their time, go in and actually have a conversation with sellers to kind of figure out exactly what those pressure points are, the pain points that they're having. We're able to get much better recessions for them, either in terms of a price or some sort of credit.
Okay, so since our clients are going to be leaning on you to figure out what house they have the best opportunity to get the best deal on, what are some things that you're looking for in the inventory that you're looking at in the MLS to help determine which ones to be more aggressive pursuing?
That's a great question. So the first thing is that we're always going to look at is beyond what the client's goals are. We've already figured out what their goals are, what they're looking for, what kind of areas they're looking at. The first thing we're going to look at is days on market. If that property has had longer days on market, those sellers generally are more willing to have a conversation about a price reduction, say, compared to a property that just hit the market 2 days ago. So we're going to be looking at days on market first as one of those leading indicators of, hey, this is somebody who might be able to work with us a little bit here on the price or some kind of credits where we can buy down the rates.
When it comes to the clients that you're representing, what are some things that you're negotiating for them that you weren't able to do before?
Yeah, that's a great question. I can give you an example of a client that we just worked with here in the last week where we were able to get them the property under contract for about $50,000 what it was previously listed for. In addition to that, we were able to get them an additional $15,000 in closing costs. So my buyers, they're not even having to really pay anything in closing costs. I think they're paying like a total of $600 or $900 in closing costs, and that's it. So they're out of pocket with very little money. In addition to that, they were able to buy down their rate, and I want to say they're like down to 4.9%. So they've got a pretty solid interest rate. They've got little money to actually close on the property, and they were able to get it significantly below the original list price.
And then with that property, do you think it's going to appraise low, or do you think it might actually end up appraising higher than the price that they paid?
The appraisal already came back, and the appraisal came back at value for what we got it under contract at.
One of the things that I've noticed is that prices were higher, and now that interest rates have gone up, we're getting clients' properties under contract at lower prices than where they listed at. But when the appraisers go look at the comparables, they're actually seeing, oh, the comparable sales are much higher than this one. So oftentimes the properties are still appraising, in this case it didn't, higher than the price that we're negotiating. And that doesn't include those closing cost credits. So that's really important. I mean, if you think about an FHA buyer buying an $800,000 house, their down payment's going to be 3.5%. That's going to be roughly right around $25,000. But then you may have another $15,000 in closing costs, right? Mm-hmm. So you're maybe 55 to 60% of your down payment is closing costs. It's significantly higher. But if you're getting your closing costs covered and you're using an FHA loan or a low down payment loan, you're actually able to get properties for very little money out of pocket. And I think that that's something to consider because real estate prices traditionally have always gone back up. After the market takes a little bit of a hit, they come shooting back. If you look at anyone that bought a house 20 years ago, 30 years ago, they've made so much equity, you can't even really put it into words. And so imagine the ROI if you're able to go in there with a very low down payment and get the sellers to cover your closing costs, and then your property's worth 3 or 4 times as much in 20 or 30 years. Is that something that you've sort of been walking the clients through who are worried about buying in this market?
Yeah, absolutely. I mean, that's the first thing you have to do is you kind of got to zoom out and look at, number one, what is the client looking for? But number two, what's their long-term goals, right? If somebody's saying, hey, I want to flip this house and sell it, 6 months down the road, then we might have a different conversation at that point. But if it's just a traditional home buyer who's looking for, a great house hack or a great long-term investment, then yeah, absolutely. Let's look at what this house is going to be worth in 30 years from now and what are you paying for it. The other thing that we do when we zoom out is we zoom out and look at, hey, if you would have bought this house, 12, 16, 18 months ago, you may have had a completely different type of offer. You may have had to pay way above the list price for this property. You may have had to remove your appraisal contingency or an inspection or a loan contingency. So right now, buyers have so much more leverage and so much more opportunity to sort of protect themselves than they did in the last year and a half.
That is a great point, and I'm glad you brought that up. The last 5-6 years, most buyers that wanted at least the best property, the best inventory, they had to waive an inspection contingency, waive an appraisal contingency, sometimes waive a loan contingency, and just hope that they ended up liking the home. And it sounds like that's not the case. So what are some things that you're doing to negotiate for your client specifically around the contingencies that you're now allowed to get in the contract again?
So we tend to go in a little bit more conservative. So fortunately in Sacramento, it's not quite like the Bay Area where it's sort of the norm for people to remove those contingencies. Sacramento, it's always been somewhat commonplace to have them. If anything, in the last couple of years, it's been crazy with how many people have been removing them. So a lot of times what we do is we have that conversation up front of, here's what we're going to do to protect you as our client. We're going to make sure we keep these contingencies, come in with conservative timelines based on what the appraiser can do, based on how quickly we can get the inspections done. And more often than not, right now, the sellers are more than willing to allow us to have those longer contingency timelines, which works out much better for our clients.
So what about when an inspection report comes back and it's got significant things that are being pointed out?
So the first thing that we do is we look, when we're out actually physically at the property, we look for any kind of red flags to where we look and see, okay, are we going to have to get an additional inspection here? Do we need to have a plumber come out or an HVAC specialist or a sewer specialist? We're actually going to go in and figure out what we need to do to see if we need additional people to come out. And then the great thing is, sellers are much more willing, especially with some of those major CapEx items like HVAC, like plumbing, like electrical. They're more willing to provide concessions. I can give you another example of some clients where there was a significant amount of Section 1 work that needed to be done. In addition to that, there was chimney work that needed to be done, probably $15,000 worth of work. In the past, the sellers would have said, hey, we've got 7 other offers right behind you that are willing to take this house as is. There's no way we're going to give you $15,000. Now what we're noticing is sellers are much more reasonable in terms of the items that need to be addressed and that are real expenses for our clients. And so we're able to have much more reasonable conversations with our sellers than we were before.
So Section 1 work, you're saying, is a indication that there's an active infestation. And that's something that would be like fungus, that's a form of dry rot, or termites, or even a rodent, something like there's rodent feces. There's definitely rodents here. And then Section 2 would be something that is likely to lead to an infestation. This could be wood that is exposed and touching soil where termites could get into it, things like that.
Yeah, things like that. plumbing leaks that are active that maybe have been leaking just for a little while, but they haven't quite created the issue within the wood. And so, or it could be maybe a gutter that is slightly broken and now the water when it drains is hitting the framing of the house. And so there's certain things like that that could turn into a Section 1 issue. And so you got to make sure you take care of it before it becomes a big issue.
And you're saying that now, for the first time maybe in your career, you're actually able to use that information to negotiate credits back for your clients because there's not 9 other buyers lined up to buy that same home.
Absolutely. And not to mention that these are true concerns that buyers have right now, especially because when they're buying a house, they don't know what the market is going to do. They don't know what interest rates are going to do. And so that's a conversation that we have with the sellers to let them know that these are not, fake, things that we're making up. These are actual, true expenses that the buyers are going to have to deal with down the line. And with all the uncertainty that we're seeing right now, we want to make sure that we're trying to save as much as we can and negotiate the hardest as that we can for our buyers to make sure that we're protecting them, we're protecting their best interests, and we're protecting their money.
Okay, that's awesome. What about when you're choosing which markets you're advising your clients to pursue? It could be a neighborhood in a specific city or one city over another one. As uncertainty looms and there is a very real possibility that prices can continue to drop, is there any specific advice you're giving on if people should be targeting lower class neighborhoods or higher end neighborhoods? What's your thoughts on where the safest place to park your money is right now?
Yeah, that's a great question. So I just had this conversation with a buyer client yesterday, and there's 2 basic things that we talk about when it comes to the Sacramento market and where is the right place to buy. The first thing is absolutely the areas that tend to have the better school scores are going to be more insulated than the places with the lower school scores. And so the first thing we're going to look at is where are the places within our community that have the higher school scores. If they have a higher school score, chances are that's going to mean it's a nicer neighborhood and it's going to have less chances of that place sort of crumbling under a recession. The second thing that we talk about is what type of property are you looking for? So if you're looking for a single family property, you may want to focus in the areas with the good school scores or the areas that we would consider in the path of progress. And so what we're looking for specifically in the Sacramento, we have a lot of growth happening out here compared to, say, the Bay Area. And so there's a lot of, number one, population trends and migration from the Bay Area and other areas. But number 2, we look at where are the hospitals being built. So in Sacramento, we have about 2 or 3 major hospitals being built right now. And we talk about this is the area we would consider the path of progress. There's a lot of growth. There's a lot of healthcare jobs moving in. And then we look at other areas where we've seen growth in the last few years. And so some of those areas in Sacramento tend to be like the downtown, midtown area. There's this huge rail yards project that's going to be happening that's doubling the size of downtown Sacramento. And so that's a big part that we look at as well as in terms of, hey, what areas are we seeing that has a more path of progress?
So as someone's listening to this and they're not in the Sacramento market, they have a different city, what's some advice that you can give them of things that they can look for that they should sort of identify and target as trying to buy real estate in those locations?
What's happening in that town in terms of population? Are you seeing people move towards this area or are you seeing people move away? If you're seeing people move away when you look at the data, you may want to consider looking at, well, where are those people moving to and start to target those other areas. The second thing that I would suggest is that you look at the area. It kind of depends on your goals, really. And so what I mean by that is, does this area support your specific strategy that you want to use? If you're looking to invest in short-term rentals, you want to make sure that short-term rentals are accepted and well known in this area and that the competition is going to be too stringent for you. Or if you're looking specifically for cash flow, then you might want to make sure that this is an area or a market that cash flows. And so it really depends on your goals. So the first thing I would suggest is making sure that you know what your goals are before going in.
All right, so let's sum up some of the stuff that we've covered here. One thing is to consider days on market when you're deciding which houses you want to aggressively pursue and to have your agent find the stuff that's been sitting on the market longest and going after those properties. Another one is to write below asking price offers if you see they've been sitting there for a while and negotiate your closing costs paid by the seller up front. Another thing is make sure you get all the inspections that you can and bring that information to the seller and say, hey, I need you to credit me or make these repairs or else I won't buy the house, because you finally have options. You can can go after other things. So you don't have to waive these contingencies and you can ask for credits. Another would be looking to buy in the areas that people are moving into and where you're seeing development happening, as those are the ones that will weather the storm if indeed one is coming better than some other spaces. Can you think of anything else that I missed that we talked about?
Yeah, I would say make sure you're working with an agent that actually knows what's happening in the market. There's a lot of agents right now that I've seen that maybe don't necessarily, they haven't noticed the change. They haven't quite adapted to the change. So make sure you're working with an agent or a team that does a lot of transactions, that does a lot of deals in that market, that is aware of, and they can feel the sort of the breathing ups and downs of the market and know the day-to-day changes. So make sure you're working with a team that really knows what they're doing, knows their area, and knows exactly what's happening in the market.
That is such a good point. I'll wrap up with this. I have a house I put in contract a couple of weeks ago in the Smoky Mountains, and when my agent was going over all the possible places, this one was listed at 1.5 million, which I thought was high compared to other properties, but not insanely high. And my agent said the listing agent is in Nashville. He's 3 hours away. There's no way he knows this market. And that's one reason that they listed the house way too high and it just sat there for a long time. Long story short, I pursued that house harder. I ended up getting it under contract for just over $1 million, down from the 1.5 it was at. Now, I will say it was never worth 1.5, but I do think it could have sold somewhere over 1.3 and 1.4, somewhere in that range. So this one was a fantastic deal of mine that I got specifically because the listing agent wasn't from the area, didn't know the property. It had sat there for 100-something days, listed way too high. The seller now thinks, well, I got to get something for it. My offer looked good. So when you're buying, you want to find a listing agent that doesn't know the area. When you're the buyer, you want to find the list or the buyer's agent that does. And I think that that's fantastic advice. Kyle, thank you very much for the job you're doing for our clients, for your time here today, and for sharing your knowledge. We'll catch you on the next one.
Thanks.